Hi, welcome to Numerix Video Blog. I'm your host, Jim Jockel. Joining me today from Europe is Udi Sella. How are you, Udi?
Very well. Good to be here, Jim.
It is great to finally have you in the studio. It has been way too long, and I'm sure all of our guests will appreciate a better connection versus having you time delayed from our regular discussions.
No, that would be perfect for once.
I know. So let's talk some headlines. Out this week, ISDA came out with its new survey on margining, where dealers have posted 1.4 trillion of collateral for derivatives trades. Obviously, last September, dealers were forced to comply with regulatory margin requirements, especially around non-clear trades. And now we have seen over $1 trillion in margin being produced for non-clear trades. Break that down: 107 billion in terms of initial margin, and 870.4 billion for variation margin. So what are some of the concerns in the market now? Now you're having a lot of money tied up, a lot of standardization among what's eligible for collateral, but economically we're also coming to the end of some quantitative easing regime. So what could the market expect now that we're seeing so much being produced in collateral?
Well, clearly there is more demand for, let's start with, as you mentioned, eligible collateral, so cash mostly to a large extent, potentially also government bonds. One thing that we see is opportunities created for investors to basically lend this money. So it's interesting because this is a new configuration, if you like, of investing, but also undertaking some market risk. So this is definitely something that we're looking into as well as a firm. It seems pretty obvious that as you know, the SIM margining of non-centrally cleared trades would expand and cover more market participants, because for now I think it's about 60 participants, if I'm not mistaken. Mm-hmm. And towards the regulatory calendar of 2020, we would see more and more institutions being liable to posting, to margining these trades. There will be an even larger demand for collaterals. Some people say it could reach even, some guests go up to $5 trillion US dollars. So that means cash out of the market. At the same time, it seems that we're reaching the end of the monetary easing of the main central bank. So US, we know that for a fact. ECB, although it hasn't been announced yet, seems that it's about time to start reducing the balance sheet, which is about 4 trillion euros, I think. And inflation in Europe is picking up. The same is in the UK. There were even speculations that the rate would be hiked this last week. So it seems we're towards the end of the cycle. At the same time, you're looking at equity markets almost at the top. You're looking at credit spreads, which are very tight, very low yields. So it will be interesting how those two things will collide. Reducing demand from central banks and increasing demand for collaterals. So basically, these are two pressures that could increase the price of money.
So obviously, credit spreads are very, very low. Eligible collateral is now, post-crisis limited. Could we see short squeezes in the market driving up some of these prices?
I personally think that this could definitely come. We're not that far away. That's my personal take. Just given the positioning of the market at this stage, and we mentioned earlier this new angle, if you like, of lending money for eligible collaterals. I mean, this could be an interesting way to invest, because it doesn't seem that investment in fixed income is completely riskless. At those levels, it's more like probably the yields will be higher and the price will go lower.
So at what point do we see any potential to reopen the debates around rehypothecation?
I mean, if you look at that as a way to I mean, we do see structured finances back. We're just 10 years after the subprime crisis. And so I personally think that this would be a good way for banks, to if you like, quote unquote, clean balance sheet and reduce the regulatory capital charges. So yeah, I actually think it's a very good point. Thank you.
So moving on to headlines, BIS hunts for missing debt in terms of inflation. So a new report came out over the weekend looking at non-financial corporates utilizing FX forwards, FX swaps, and obviously most likely for hedging versus speculation, but now questioning elements of accounting treatments and missing debt on the balance sheet and propping up. However, many corporates are utilize these instruments for stability within their their earnings and whatnot. So what's some of the reactions to the BIS news?
So first of all, I would say that non-financial firms that use FX swaps, at least from my experience, is really for cash flow purposes. Um, so clearly you carry there is a counterparty risk, of course, that you know, but you're holding to one side of you're holding to one currency, let's say to yen, and your counterparty is holding, let's say, for dollars. So if your counterparty goes default, let's say the one holding dollars, you still hold the yens, right? So your real risk is that those yen will weaken dramatically, right? So the dollar yen will go up, and then in fact, if you need to buy your dollars back, you will need to produce much more yens than what you really received from your counterparty. So yes, in essence, in my view, you're really holding more of a foreign exchange risk due to the price of the underlying asset. And indeed, I think there's a valid point here that we don't know how this is quantified, and does it, as an investor in, let's say, in a public firm that holds a huge FX swap book, does it get treated? Am I aware of that? And is it really priced into the firm's price of money, if you like, your spread? Yeah, that's a very good point.
You know, one of the things that came back to me was, and not to be alarmist, was looking back at the Enron documents back in the day in its annual report with the asterisks and with the kitchen sink document. What was in that kitchen sink? And arguably Enron wasn't a power company; it was a trading company, and never looked at by the market in that regard. But it also makes me think in terms of other disruptive companies. You know, you now see headlines of Tesla's not an auto company, it's so much more. So I think this is going to be an interesting story to watch and see if there are any implications from the accounting side of the world, and whether or not some of this study gets incorporated into the next generation of accounting, which is good for the auditors.
There's also a point there which is valid, I think, with regards to, let's say you're looking at a swap, FX swap, let's say a 2-year swap or a 1-year swap. You're also looking at an interest rate exposure, because it is when you fix the FX swaps price, you fix it with a fixed yield. So if yields are going to change massively in the coming year or two, or significantly, firms will take an interest rate risk hit.
So, just kind of bringing this all together, and, you still see concepts of bubbles out in the marketplace. And, throughout this conversation, I'm seeing potential trillions coming out of the market as it relates for collateral, yet, billions being potentially kind of quote unquote hidden off balance sheet. Arguably, most of these FX awards are probably centrally cleared anyway, or through their FCM and dealer. But when we start thinking, alternative currencies and massive fluctuations in Bitcoin, as we've talked about, going from 4,000 to 3,000, the geopolitical risk of South Korea that's going on right now, and right here in New York, traffic's all jammed up because of the UN meetings this week. The changes in quantitative easing, the undercurrents of inflation, more money's coming out of the market. When you sit back as, creating a long-term view, what are some of the things that you're thinking about, and how would you, from your portfolio, start to think about how is this going to impact my hedging?
That's really interesting, your question, because my personal view, and in fact I've acted that way, is I think that the risks out there are very high at this point. I think that we've seen a period of almost like 8 years of equity market going pretty much one way, of volatility extremely low, of a lot of leverage. So you mentioned, we know that the overall size of the world's economy is around 70 to 80 trillion, depends where you place the equity market. You're looking at the OTC derivatives, which are what, $600 trillion?
Right. Throw in the equity markets on top of that. So
And then we are running, some geopolitical risks with, for instance, North Korea, as we mentioned earlier. So to me, it's pretty much the question of, what will trigger it? Because every time there is a period of markets, let's say equity markets going high, people say that's the new economy. And then eventually there's a correction, and then, the markets continue going up. So, yeah, I'm a little bit, concerned with regards to the market continuing going this way. And let's put it this way, I will not be surprised if I see, or we see, witness a correction. And we cannot even say what will trigger it, but something potentially will happen. That's my personal view.
So there's always winners and losers in every correction, and those who see it first many times are the winners. At what point, if I'm going, quarters out, how many more of these events do you, from your perspective, do you see before you start, pulling back and going to cash, or even gold ETFs now are starting to rise pretty dramatically as well. So when do you see the safe haven run?
So actually we see two things, right? So when there is when if you like the pressure goes higher and people are concerned, so we always see gold, we see Swiss franc, we see dollar yen. So basically people buy Swiss franc, people buy gold, people buy yen. We did see interestingly a lot of activity out of Asia with regards to the cryptocurrencies. I mean, it went so much, like August, at some point it went 70% up. So clearly there had to be a correction from 5,000 to around, 4,000. That's normal. And this is interesting because this is the first time that you can basically invest without any, in a tool that doesn't have any, which is really not regulated, right? Now China has started to regulate, but, and this I think is a game changer in the respect that, it's no limits. You can trade it on many, segregated platforms, and there's no central governing. So I think that would be interesting. In terms of when to go back.
Well, let me drill down on one question here. Dollar yen is safe haven, but is it anymore? Right? We've had long conversations of Japan moving into a negative rate environment. Stressing bank lending. We also see the North Koreans lobbing missiles right over their head. So what do those two factors do to making dollar yen a safe haven?
It's a fantastic question. I mean, you can arguably you can say that. So if you like, the lowest of dollar yen we've seen was 108. You can argue that in the past probably could have broken the 100 potentially, and maybe indeed some of the flow, especially as I said, especially from Asia, went into the cryptocurrencies. Specifically in Switzerland, we know that the central bank still intervenes to support the Swiss franc against the euro, and it's true. We keep seeing money looking for return. So M&A deals, stocks, even firms buying their own stocks, etc. Something's going to happen.
Okay, last question for you, and we're going to wrap this up. iPhone 10, $1,000, yes or no?
No.
Thank you very much. Udi Sela, our resident FX expert from EMEA, joining us live here in the Numerix studios. Udi, thank you so much for your time and your thoughts today. We always want to talk about the topics you want to talk about. Please follow us on Twitter @NXAnalytics and on Numerix.com and LinkedIn. Thank you so much. I'm Jim Jockle. Talk to you next time.